Reuters' Alex Smith spoke to John Studzinski, Senior Managing Director of the Blackstone Group, and asked whether the relative calm in Europe meant the worst was over.
Alex, I think the operational word in your question is relative. Obviously, Europe is calmer. There's still, I think, about 550 billion euros of debt to be restructured, either under the context of sort of pretend, amend, and extend. And of that, there's probably about 150 million of debt that has to be restructured this year. So while people are no longer worrying about the euro collapsing or disintegrating, I think there's still a great search for economic regeneration and growth within Europe.
You're looking at a situation where perhaps markets are more investable now than they were for firms like yours?
Well, Blackstone has a complex set of things it invests in, and they really, it depends on the country, depends on the opportunity, depends on the project, depends on the time. So I'm not going to generalize. And we will continue to be very tenacious and very curious. There are things to invest in, and there's going to continue to be a lot of, obviously, credit. And of course, the remaining area, I think, is real estate. There's still a lag in the amount of real estate that financial institutions are prepared to sell. And I think you're just going to continue to see that logjam break up, hopefully, in 2013.
And are the markets right for deal making?
When you look at let's look at the US for a minute. You've got an enormous amount of cash among US companies, which we've been talking about for 3 years, and we're getting tired of talking about it. But the new element or the nuance from that is that activists are looking at that cash and they're saying, a lot of cash, yields are going down, your margins are starting to get squeezed. So many of these companies are saying, I better spend this cash, I've got to do something about these margins. So I don't think companies are going to diversify, but I do think the big companies, consumer, healthcare, are going to be very aggressive about looking for investments in their core businesses. They've done all they can on the cost rationalization side. They've also getting more and more pressure on the governance side. So they're going to have to take their strategies one step further.
And will they look to do those deals in cash or in paper? They've got the cash available?
The stock market's motoring. Depending on what they're doing, I think most of them are going to do those deals in cash or cash and short-term debt.
What about bank deals? I mean, we've obviously the banks have been at the centre of the European crisis. Do you see further consolidation among the banks? We've seen a lot of consolidation in places like Spain under pressure.
Yeah, I think that's a very amusing question. I think Europe is going to be a continued spin-off divestiture mode with respect to financial institutions. I can't imagine too many boards, unless they have a regulator's gun to their head, are going to take on a series of risk and audit balance sheet issues from another entity, unless it's either in a bail-in or bail-out mode or something absolutely under duress. So I think there's going to be very little material bank M&A activity. I think there are a number of banks that still have to shed assets.
Right.
And it's interesting, last year, for example, 47% of global M&A activity was actually in what I call pruning. And a lot of that, about 12-15% of that was financial institutions. I think you're going to see a lot more pruning, certainly in Europe this year.